Across to Dehn, Head of Research at Ashmore Investment Management. Jan, appreciate you joining us here on CNBC TV 18. Let me start by asking you about what you make of the emerging market currency route, and particularly in India, the way that we've actually seen the rupee in a free fall. Do you believe that we've actually reached a top? Do you anticipate some amount of stability coming back in?
I think the key points to make here are the following. First of all, there is a brand new or relatively new piece of major uncertainty in the global outlook, of course, since May, which is the question of monetary policy in the United States, when tapering starts, how fast it happens, and what, importantly, that means for interest rates. Every time we have a large piece of uncertainty in the global economy, there is a knee-jerk reaction to sell emerging markets. There is then a particular focus on where you can see vulnerabilities within emerging markets, and then a momentum catches up and pushes the trade along. And that's essentially the environment we've been in since late May. The other important point to make is that, of course, emerging markets and Asian central banks, emerging market central banks and Asian central banks in particular, of course, have a tremendous amount of ammunition in terms of their central bank reserves. And the intervention that we have seen in by emerging market central banks, say since June, only amounts to about $15 billion across Asia. Now, as you know, the Reserve Bank of India has, by its own, about $270 billion of reserves. What this is telling you is essentially that emerging market central banks are by no means losing any kind of control. They're quite deliberately holding back on intervention because they actually quite welcome a bit of currency weakness. It's going to help stimulate their economies. It's going to make their exports more competitive. They're probably also waiting for some of the very speculative longs that went into emerging market local currency in the first half of this year to really be properly washed out. I expect that's eventually going to lead to a more decisive and aggressive amount of intervention by emerging market central banks, probably at a time when everybody is short, and then we're going to see quite a different type of price action. So I think it's important to keep these things in perspective. This market is very technical, it's running on very low volumes, and we still have this uncertainty ahead of us in September.
So given that uncertainty and given the fact that we don't know eventually whether the Fed will start to taper in September, though the FOMC minutes seem to suggest very clearly that there is broad support for the tapering timeline, in that situation, and given the fact that we haven't really seen any fresh measures being announced by either the Indian Central Bank or the Indian government to try and prop up the rupee, what levels are you watching out for as far as the Indian currency is concerned?
Well, I think we are actually probably getting towards the latter stages of the sell-off. The reason why I'm saying that is not because I have a particular level in mind for the Indian rupee, is because of what I see in the U.S. Treasury market. We've seen U.S. Treasury yields go quite high, and I'm quite certain in my mind that the Fed does not want to see real interest rates rise materially in the United States. And in fact, the real risk that developed countries are facing here is that emerging markets just engage in some more selling of their dollar positions. And that, of course, would push real interest rates higher in the United States. And we're currently reaching a level where the steepness of the yield curve in the United States, in part because of selling from emerging market central banks, is now reaching a level that is at the highest that we've seen over the last 30 years. And I don't think that's the intention of tapering. It's important to understand why tapering is happening. Tapering of QE is happening because QE has become counterproductive. We now have a situation that every time we have a decent economic number being released in the United States, the stock market begins to fall. That's because the market cares less about what better economic data will do to earnings and more about what it means for the next sugar high of QE. And that's clearly a sign of a policy that may have had great effect at the beginning, but has now become sick. And for that reason, there is no doubt in my mind whatsoever that the Fed is going to taper. And getting to the other side of that, eventually getting to a situation where monetary policy is determined by interest rates and not by printing money, is ultimately quite a healthy development.
Jan, you were talking about how emerging market central banks have not utilized the options available to them at this point in time. They are perhaps waiting for, a better, more appropriate time. What kind of options do you believe that the Indian Central Bank, for instance, may perhaps want to explore? Because we've had the government come out and the Reserve Bank categorically today come out and say that there is no question of any kind of capital control. That is not the intent of either the government or the central bank. There's been a lot of talk about the possibility of a sovereign bond. They believe that it's still on the table, but they haven't decided on whether they will proceed with that. What kind of options would you believe would make sense?
The wonderful thing about India's situation is that it does have, as you just suggest, a lot of different options, and all of the measures that you mentioned are clearly possibilities. I think the most obvious, I think central banks in particular, when they intervene in markets, want to make sure that they are taken seriously. So the measures, the interventions that we've seen by a number of emerging market central banks recently has really been very modest, to try to limit the most extreme market moves, try to smooth the exchange rates somewhat to avoid creating, if you wish, too much volatility in the market. But they're also quite savvy guys. They're sitting there, they're watching the market very carefully, they're following the technicals very closely. And once we get to a situation where they feel that the currency has weakened to a point where it really starts to feed into inflation expectations and threatens to raise real long-term interest rates in the yields, long-term yields, then I think they're going to be much more inclined to intervene. And when they do so, they can do so in a number of different ways. They can certainly ease access for foreigners to come into the local bond market, where bond yields are now becoming quite attractive. They can certainly intervene directly by moving their exchange rate reserves, intervening directly in the currency markets. And of course there India has an enormous arsenal. So there's no really any doubt whatsoever about their capacity to do so. I think it's really just a question of timing.
All right, Jan, we'll have to leave it there. Appreciate you joining us here on CNBC TV 18 with your thoughts. That is Jan Dehn of Ashmore Investment.